The power of dividend. Hi everyone, thanks for checking out this video. Here I want to discuss one simple but important concept in long-term investing, dividend. Note this video is for educational purposes only and it should not be treated as financial advice. Talk to your financial advisor for your investment and hopefully you can ask them some additional insightful questions after this. When we consider long-term investment in mutual funds, ETFs to track some indices, for example, the benchmark S&P 500 or SPX, some of us look at the index and may be thinking, this is not so impressive and probably not a good place to put money in. Looking at the history of S&P 500 since 2000, its gain is about 155% as of 2020. So every year, you only gain 4.7% on average after compounding. Then, when you look at the first decade, it's even worse. You are even losing money. So most of the gains in the last 2 decades for SPX actually came from the period after the 2008 subprime mortgage crisis. One of the things we're missing when we look at the index only is the dividend. For long-term investing, we should look at the so-called total return version of the index. If you Google SPX total return, you can find the chart in Yahoo Finance. If you plot it against the SPX index itself, you can see the S&P 500 total return gains about 281% over the last 2 decades, quite higher than the index itself. So every year you gain about 6.7% on average after compounding. That's 2% higher than 4.7% of the index itself. This 2% gain is from the dividend and it's reinvestment. We can take a look at its current dividend yield. If you Google SPY dividend history, SPY is just the ETF tracking SPX. You can find the history in Nasdaq website. Here you see the current dividend rate of SPY is slightly higher than 1.5%. You can also see the dividend is paid quarterly. Usually your mutual fund that invests in this ETF would reinvest the dividend and buy more shares so the snowball can continue to grow. I also want to mention that long-term investing still comes with great risk, even if your investment horizon is 20-30 years. Consider the scenario. What if you really need to spend money during an economic downturn? For example, what if you retired just after the crisis? So you're not putting in new money anymore and start withdrawing instead. Or what if you plan to buy a house 5 years from now, but the economy happens to be experiencing a recession in a few years? So when you consult with your financial advisor, don't forget to discuss your investment time horizon, some key milestones in your life, and also big expenses expected down the road. That will help them help you. Okay, that's it for today. Hopefully you'll find this useful and hope to see you again next time.